Welcome back to the deep dive. Today, we are staring down the barrel of something the market has been whispering about for years. But now the shouting has started.
It's definitely getting louder.
We are talking about the commercial real estate refi wall of 2026 and 2027. And look, I know commercial debt maturity sounds like the driest topic imaginable, but the scale here is, it's terrifying.
It really is.
Yeah.
We're talking about over $1.5 trillion cumulatively just in the U.S.
And for 2026 alone?
For 2026, it's about $875 billion maturing. But, if you just look at the zeros, you miss the actual story.
Right.
The story isn't just the volume of debt. It's the psychological shift that's happening in lending offices right now.
Exactly, because up until now, I mean, really through 2023, 2024, even parts of 2025, the industry vibe was extend and pretend.
Take the can down the road.
Lenders were basically giving borrowers a pass, offering these short-term modifications, just hoping that if they waited long enough, interest rates would drop and save everyone.
It was a strategy of hope. But looking at the sources for this deep dive, that party is officially over. We're entering an era of what they're calling liquidity discipline.
Liquidity discipline. It sounds so professional, but it implies something pretty ruthless.
It is ruthless.
The sources seem to suggest that by 2026, the waiting game is over. It's no longer about who has the best building or the nicest lobby. It's about who can write a check.
That is the premise of this entire deep dive. We're exploring who survives this wall and who crashes.
And to make it even more interesting, we're not just looking at a standard market correction. We have to layer on a massive geopolitical wildcard,
The potential suspension of the USMCA trade agreement.
which creates this unbelievable divergence between the U.S. and Canadian markets. But let's hold on the trade war for a second.
Okay.
We need to set the table with the baseline reality of 2026. Let's unpack this liquidity discipline. What's the first thing lenders are going to stop tolerating?
The first casualty is what the sources call the exit cap rescue.
Okay, let's break that down. For the last few years, a borrower could go to a lender and say, sure, rates are high today, but look at my pro forma. In 2 years, rates will drop, cap rates will compress, and the value of my building will snap right back up.
Right. They were relying on a future valuation recovery to justify the loan today. And, for a while, lenders kind of nodded along because they didn't want to book a loss.
But in 2026,
That assumption gets pulled. Lenders simply stop believing that cap rates will compress enough to refinance at par without fresh equity.
so they're done betting on the vibes of a recovery.
Completely. They're shifting from future hope to NOI durability. And specifically, they're moving from pro forma underwriting to a T12 reality.
T12 being the trailing 12 months, so actual verified history.
Verified, untouchable cash flow. Lenders won't underwrite lease-up hope anymore. So if you have an office building that's, say, 70% occupied and you tell the bank, oh, we're in talks with a major tenant, we'll be at 95% next year.
The bank is going to say,
That's great. Come back when they sign. Until then, we lend on the cash flow you have today.
which is a huge problem if you bought that building thinking you had time to stabilize it. If the cash flow isn't verified today, it essentially doesn't count.
It creates a massive gap. And this shift is driven by the realization that problems in sectors like office and Class B multifamily are structural, not just cyclical.
They're not just waiting for a turn in the cycle.
Exactly. The fundamental demand has changed permanently.
There's another detail in the research I found really telling, the interest reserve drought. It feels like the piggy bank is finally empty.
That's a critical point. Think about all those loans that were modified back in 2023 or 2024. A lot of them survived because they had interest reserves.
Right, buckets of cash set aside to pay the mortgage.
Basically, yeah. They were borrowing money to pay the interest on the borrowed money.
It was a lifeline.
A crucial lifeline. But those reserves were usually calculated for 18 to 24 months. By 2026, those buckets are dry. The dry powder is gone.
So now you actually have to pay the mortgage from the property's cash flow. And for many assets bought at the peak, the math just doesn't work.
It just doesn't.
Which brings us to the survival mechanism. If the math doesn't work and the lender won't extend based on hope, what determines if you keep the keys?
It comes down to one single factor: sponsor equity capacity.
The check to close.
Let's do the refi math.
Okay.
Because it's brutal, but it's necessary. Say you bought a building in 2021 for $100 million.
Okay.
Since then, values are down, roughly 15% to 25%? So your asset is now worth, say, $80 million.
You've already lost your entire equity cushion.
Right, but it gets worse. Now, lenders are demanding lower loan-to-value ratios, lower LTVs, and higher debt service coverage ratios
Because rates are higher.
because rates are higher. So the new loan they offer you isn't $60 million, it might only be $50 million.
But you still owe the original bank something close to your original loan. There's a proceeds shortfall?
Exactly. Even on good assets, there is a gap. To get that new loan, the borrower, the sponsor, has to physically pay down 10% to 20% of the principal in cash.
So using your example, if I owe $65 million, but the new bank only gives me $50 million, I have to show up at closing with $15 million in cash.
Correct. And this creates a massive bifurcation in the market. You have the haves, the pension funds, the sovereigns, the well-capitalized REITs. They hate doing it, but they can write that check.
They de-lever the asset and live to fight another day.
And then you have the have-nots,
The syndicators, the private equity firms,
the ones operating on zombie carry.
zombie carry, meaning their equity stake is mathematically worthless.
It's just a line on a spreadsheet.
hmm
It's not cash in the bank. They can't make a capital call because the deal's underwater, and they don't have the balance sheet to fund it themselves. So they crash.
And there's a silent killer mentioned in the notes too, CAPEX.
CapEx is the thing nobody models correctly until it's too late. I mean, imagine you're facing that refi gap we just talked about. You're scraping together cash.
Right.
But on top of that, your building also has mandatory retrofits, maybe new energy codes, or just tenant improvements you need to land new renters.
And the lender isn't going to finance those improvements if the LTV is already maxed out.
No way. They count that cost as another equity check you have to write. If you have $5 million in deferred maintenance, that's $5 million less you get in loan proceeds. It's a force multiplier.
Okay, so that is the baseline nightmare for 2026. A market defined by liquidity discipline, falling values, a massive need for fresh cash. That's hard enough.
It is.
But now let's introduce the twist, the geopolitical wildcard.
This is where the analysis gets really fascinating.
We're talking about a scenario where the USMCA, what used to be NAFTA, gets suspended in 2026. A full-blown trade dispute. Now, usually we think of real estate as hyper-local.
Yeah, of course.
Why does a trade agreement matter to a landlord in Chicago or Toronto?
Because in 2026, real estate effectively becomes geopolitics. If the USMCA is suspended, we see a massive divergence between the US and Canadian real estate markets. And it starts with asymmetry.
Asymmetry meaning the pain isn't shared equally.
Not at all. The U.S. economy is, roughly 3% dependent on trade with Canada. It's significant, but in the grand scheme of U.S. GDP, it's a blip.
But Canada...
Canada is roughly 33% dependent on the U.S.
Wow. So for the U.S., it's a manageable headache. For Canada, it's a systemic shock.
Precisely. In the United States, a USMCA suspension is categorized as an interest rate risk. It might cause some inflation, maybe the Fed keeps rates a bit higher for a bit longer, but the economy is diversified.
Liquidity stays deep.
But in Canada, the research calls it tenant solvency risk.
That's the structural break.
It is. If you own an industrial building in Ontario and your tenant exports 80% of their product to the U.S. and suddenly there's a 25% tariff, that tenant stops paying rent.
So it's not just that borrowing is expensive, it's that your income literally evaporates.
Correct. And the metrics reflect that pain. The sources modeled this. In Canada, that equity gap, the check you have to write, is 10 to 20 percentage points larger than in the U.S. for a comparable asset.
That's huge. That's the difference between a painful refi and a complete wipeout.
It's terminal for many sponsors. We're looking at valuation drops of 23% to 34% in Canada versus, maybe 13% to 21% in the U.S.
And that's because of what they call dual compression.
Dual compression. Risk premiums go up, which causes cap rates to rise and values to fall. And at the same time, your net operating income falls because tenants are going bust. You get hit from both sides.
And I imagine the banks behave differently too. I mean, in the U.S., we have a lot of non-recourse debt. You can just hand the keys back.
That's strategic default optionality, and it's very common in U.S. commercial real estate. You lose your equity, but your other assets are safe.
In Canada, though,
The banking culture is totally different. It's much more recourse heavy. Canadian banks move faster to enforcement. They don't just let you hand back the keys. They come after the sponsor's other assets.
so in this scenario, Canadian borrowers don't have the luxury of walking away. They face forced liquidation across their whole portfolio.
It's a much more dangerous situation.
Let's zoom in on a specific sector to see what this looks like on the ground. Industrial real estate. Usually, this is the darling of the market.
Right. Warehouses, logistics, everyone loves them. Under normal circumstances, yes.
Yeah.
But let's look at the industrial fallout of a trade war. Take the Windsor-Detroit corridor.
The auto manufacturing hub. Integrated supply chains, things crossing the border constantly.
Exactly. If you have a portfolio of assets on the Ontario side and a 10% tariff hits, you're in an equity squeeze. You're hurting, but maybe you survive.
But if a 25% tariff hits,
The sources call this a refi collapse.
because the tenant literally cannot survive that tariff.
The asset becomes unfinanceable. There's no durable income. Meanwhile, look at U.S. industrial. In a trade war, U.S. industrial actually remains a safe haven.
Why? Wouldn't they be hurt by the disruption too?
Short term, yes, a little, but the long-term trend is onshoring. If the U.S. stops buying from Canada or China, we have to make those goods domestically. So domestic demand in the U.S. actually supports the real estate.
So the same macro event, a trade war, crushes the Canadian warehouse and boosts the American one.
That's the divergence.
Okay, let's look for a silver lining, or at least a pivot. If I'm a sponsor stuck with a stranded industrial asset in Ontario, is there a way out?
There is one potential pivot mentioned in the deep dive, but it's tricky. The data center pivot.
Ah, yes. The
Yeah.
AI boom. Everyone wants to turn their old factory into a data center.
It's the power arbitrage hedge. You aren't leasing the shell anymore. You're leasing the power connection. But here is the new metric lenders are using. Power to LTV.
Power to LTV, explain that.
It's debt per megawatt. Lenders aren't financing square footage, they're financing interconnection rights. They look at the value of the power capacity. But here's where sovereign risk twists the knife again.
How so?
Well, if you're in Ontario, in this scenario, the grid is no longer viewed as trade stable. American operators, the big tech companies, the hyperscalers, they fear what's called expropriation of priority.
Expropriation of priority. That sounds terrifyingly bureaucratic.
It means the government might step in and say, sorry, we need this power for domestic use, or we're prioritizing our own sovereign AI projects over foreign companies.
And if you're an American hyperscaler putting billions into a facility, you can't take that risk.
No. They demand political risk insurance or a massive discount. Compare that to Ohio or Pennsylvania. The sources call these fortress assets
Because the grid is secure.
because the power queue position has intrinsic value that isn't threatened by a trade dispute. Lenders will push LTV to 75% in Ohio. A sponsor there can extract $2 to $3 million more debt per megawatt than a sponsor in Ontario,
Just because of the flag flying over the power plant?
purely due to grid certainty and political stability. It's a massive hidden premium.
This is wild. We started this talking about interest rates and loan maturities, and we've ended up talking about national security and power grids.
That's the reality of the 2026 refi wall. It's not just a financial hurdle anymore. It's a geopolitical filter.
So let's wrap this up for the listener. If we look at 2026, what is the bottom line?
The summary is this. 2026 is the handoff from time will fix the refi to equity fixes the refi. The extend and pretend era is dead.
You can't vibe your way out of this one. You have to write the check.
Exactly. The winners are those who can defend their cash flow, meaning they have real, durable NOI, and fund the gap.
And for those looking at the bigger picture,
I'd leave you with this final thought. The concept of sovereign risk is entering the real estate equation in a way we haven't seen in decades. If energy and data become national security assets, does your safe investment in a friendly neighboring country suddenly carry a geopolitical risk premium you never even modeled?
that is a question that will keep a few asset managers up at night. That's all for today's deep dive. We'll catch you on the next one.